Welcome to the Deep Dive. This is your essential shortcut for getting under the hood of the latest financial narratives. If you're trying to skip the PowerPoints and get right to the numbers and the strategy that, actually moves stocks, you are in the right place. Today, we are breaking down the fiscal fourth quarter 2025 earnings call for Twist Bioscience Corp. That's ticker TWST. The call was pre-market on November 14th, and it gave us a set of numbers that, well, on the surface looked pretty good, but the market reaction was immediate and it was brutal.
And that's really the mission for us today. We need to figure out why. Why did a revenue beat and some really impressive margin numbers get completely ignored? It was like operational execution went up against investor fatigue, and fatigue won big time.
Okay, so let's jump right into that conflict. The results snapshot, what were the top line numbers?
So Twist delivered $99 million in revenue for the quarter.
Right, and that beat the street's estimate of about $97.2 million. So that's 17% growth year over year.
Exactly. And for the full fiscal year, they hit $376.6 million. It's 20% growth. Solid. No complaints on the top line.
But there's always a but.
There's always a but. The number that just killed the sentiment was the GAAP earnings per share. They reported a loss of 45 cents. The consensus was looking for a loss of 41 cents.
So about a 10% miss. That feels significant. Management was talking up their adjusted EBITDA numbers, but does a GAAP miss like that just erase all the goodwill?
In this environment, absolutely. I mean, when you're a growth company that's been promising you're on a path to profitability, any miss on the bottom line is a huge red flag. The market basically said, great, you can grow. We see that. But you're still burning more cash than we thought.
And the stock reaction reflected that.
Oh, yeah. It was an immediate, substantial sell-off, double digits. And the volume was something like 3.3 times the average. That's not retail selling. That's institutions getting out.
Okay, so let's peel back that curtain then and look at the operational wins management was trying to highlight. Because they did build a pretty compelling case around financial discipline, especially on gross margins.
And that margin story is probably the most impressive part of the whole call. It's really critical context. They've been laser focused on this. For Q4, gross margin hit 51.3%. Right inside their guidance.
And for the full year, it was 50.7%, which is an 8-point improvement from the year before. I mean, an 8-point jump in 1 year is massive. What does that tell you?
It tells you the model is working. They're finally getting real leverage from their platform. It's coming from two places, really. One is just fixed cost absorption. They're running more volume through their facilities. And the other is they're just getting more efficient with their core silicon-based DNA writing tech.
So this is proof the underlying machine is getting cheaper to run as it gets bigger.
Precisely. And they were pretty explicit that they expect margins to stay above 50% from here on out.
Okay, so better margins are step one. What about the path to actual profitability? What did the adjusted numbers look like?
They were really quite good. The Q4 adjusted EBITDA loss was down to just negative $7.8 million. Again, right in their guided range. But look at the full year. The loss was negative $46.9 million.
Which is an improvement of about $46.5 million from the prior year. They basically cut their adjusted loss in half.
Exactly. That's fiscal discipline right there.
Yeah.
And they made sure to point out they've got about $232 million in cash.
Enough runway to get to that break-even point they keep promising?
That's the idea. They want to soothe those nerves about the cash burn.
Got it. And what about the individual business segments? Where was the growth coming from in Q4?
It was pretty broad-based, which is what you want to see. So their SynBio Write business that's making custom DNA, that grew 17%.
Okay.
And their NGS Read business, for genetic analysis, that was up 16%.
And what about Biopharma? That's smaller, but it's usually higher value, right?
Right. And it was the strongest grower, up 22%. And what's really key is they booked $11.5 million in new orders in that segment. That points to a healthy future pipeline.
Any geographic standouts?
Yeah, actually, the EMEA region, that's Europe, Middle East, and Africa, it surged 35% year over year. So they're getting real traction outside of North America.
Okay, so all of that operational success seems to lead into their strategy for the future. They're actually changing their reporting segments for fiscal 26. Why are they doing that?
Well, they're trying to align the business structure with how their most important customers are actually using their tech. They're merging SynBio, the DNA writing, with their biopharma services
into one new segment.
Yeah, they're calling it DNA synthesis and protein solutions.
Yeah.
And then NGS just gets a name change to NGS applications.
So what's the logic behind combining the D&I writing with the drug discovery services?
One word, AI. It's all about artificial intelligence. They kept bringing it up on the call. The big biopharma orders are now coming from AI-driven discovery projects. So these companies need custom DNA libraries to train their models. And then they need the services to validate what the AI finds. By combining them, Twist can offer a single, seamless, really high-value package.
Is the AI driver real, though? Or is it just marketing buzz because AI is hot right now?
No, it's very real. They put a number on it. Orders from AI customers grew by more than $25 million just in fiscal 2025. And they said these are more substantive and higher value orders. So it's not just hype, it's becoming a core growth engine.
And this is where the tech differentiation starts to matter a lot. They announced some major speed improvements that seem to play right into this. Let's start with the NGS side.
Right. So on the sequencing side, they've got this new Trinity Freestyle workflow. It's all about efficiency. So normally, preparing a sample for a sequencer can take like over 20 hours. It's a huge bottleneck.
Okay.
This new workflow, it cuts that time down to 5 hours.
And why does shaving off 15 hours matter so much?
Because for a big lab, time is money. I mean, if you can process more samples per machine per day, your throughput goes way up and your cost per sample goes way down. Like a massive competitive advantage.
So that's about efficiency. But the other big announcement was more about disruption, right? In the minimal residual disease, or MRD space.
Yeah, this is their big strategic bet in diagnostics. They're launching a product called MRD Express early next year. It's a personalized panel that doctors use to see if a patient's cancer is coming back after treatment.
And the challenge there is always turnaround time.
Always. Doctors want the results within, say, 4 weeks. But making a custom panel for each patient's specific tumor takes time. It's a manufacturing problem.
So what's Twist's solution?
Speed. Insane speed. They're promising they can manufacture and ship a personalized panel in as little as 12 hours after they get the sequence data.
12 hours.
12 hours. If they can actually do that at scale, it completely changes the game for personalized cancer monitoring. It removes the biggest bottleneck in the whole process.
That is seriously impressive tech. But the market, of course, is focused on the next 3 months. So let's talk about the guidance and that temporary problem that spooked everyone.
Right. And, the full year guidance looked perfectly fine. They guided for $25 to $35 million in revenue for fiscal 26.
That's 13 to 15.5% growth.
Yeah, solid growth. And that new DNA synthesis and protein segment is guided to grow even faster, 15 to 18%, which reflects that AI demand we talked about.
And they also repeated their commitment to hitting adjusted EBITDA break-even by the end of the year, by Q4 of 26.
They did. But none of that mattered. The market fixated on one thing, the guidance for the current quarter, Q1.
Which was?
$100 to $101 million, which is basically flat compared to the $99 million they just did. For a company like this, flat sequential growth is a giant red flag for the algorithms.
So what happened? Why the sudden stop in Q1?
It's a very specific temporary issue. It all comes down to one large cancer diagnostics customer. This customer is moving their test from research level volumes into full commercial production.
So it's like a planned shutdown. The customer is hitting pause while they retool the factory floor, so to speak.
That's a perfect analogy. They're validating equipment, dealing with regulations, all that stuff.
Yeah.
And while they do that, they aren't ordering as much from Twist. Management called it a temporary air pocket.
An air pocket. And they expect it to resolve.
Yeah, they were very clear they expect that NGS segment to reaccelerate and get back to around 20% growth by the end of the year once that customer is fully ramped up. But you know how the market is. It hates uncertainty, even if it's temporary.
Which brings us right back to the central problem here, what we're calling the credibility discount. Why did the stock fall over 10% and hit a new 52-week low?
Because this stock is just trading under this deep structural cloud of doubt. It's not just about this one call, it's the pattern. If you look at the last year, the stock is down, 32 to 34%. Meanwhile, the biotech ETF, the XBI, is basically flat. Twist is lagging its peers badly.
And this isn't the first time they've seen a big post-earnings sell-off.
Not at all. It's happened before, even when they've hit their revenue numbers.
Yeah.
The big institutional holders are they're impatient.
So what are they demanding?
Speed and certainty. Management is doing a great job talking about operational execution and hitting their adjusted targets. But the market is looking at the GAAP losses and the cash burn and basically saying, prove it. And prove it faster than your guidance suggests. They're saying, show us the actual profit, not just another slide about the path to profit.
So there's this tension between the really cool tech and the operational gains versus this deep-seated skepticism about how fast it can all translate to the bottom line.
That's it, exactly. And they are pricing that skepticism in every single day, which creates that credibility discount on the stock.
Okay, let's pivot to our last segment where we put on our analyst hats. And we have to say, this is absolutely not financial advice, but we like to pitch a kind of outrageous but plausible trade idea based on the disconnects we see.
Right. So the thesis here is pretty straightforward. You have this Q1 air pocket from a single customer transition that has just crushed the stock, pushed it to a 52-week low. But the long-term story, the AI growth, that game-changing 12-hour MRD panel, that's all still there. And the stock is, as we know, super volatile. It's prone to big swings.
So you see an opportunity in that disconnect between the short-term noise and the long-term potential. How would you play it?
I'd look at a volatility-based options trade, specifically a calendar spread.
Okay, walk us through that.
You'd make two moves at once.
Okay.
First, you sell the front month call option, so one that expires after this week Q1. You sell an out-of-the-money one, you'll get some decent premium for it because everyone expects near-term weakness and volatility.
Okay, so you're collecting cash based on the near-term fear.
Exactly. Then you take that cash, that premium you just collected, and you use it to buy a back month call option, something that expires further out, maybe in Q2 or Q3, and maybe you buy one that's slightly in the money.
So you're using the market's short-term panic to fund a longer-term bet on the recovery.
That's the trade. You're betting that by Q2 or Q3, that big customer is back online, NGS growth is reaccelerating to 20% like they promised, and the stock gets a major positive swing. You're trying to capture that rebound while the Q1 volatility melts away. It's a pure play on a temporary problem.
A very interesting way to frame how a tactical fund might look at the situation. So to wrap up our breakdown today, Twist is, by all accounts, executing well operationally. We're seeing strong margin gains, and they have these really powerful strategic drivers with AI and the new MRD tech.
For sure. But the stock price, the valuation, is completely dominated by this investor skepticism. The market is just tired of waiting for real GAAP profitability. It's treating a long-term platform story like a short-term trade.
Which leaves us with the final thought for you to chew on. The company has a plan for efficiency. We see it in the 50% margins. They have a growth engine in AI. And they have a disruptive technology in that 12-hour MRD panel. The big question is, can all of that progress finally add up to the durable, profitable scale that the market is demanding by the end of fiscal 26?
Or will this credibility discount just keep punishing them, no matter how well they execute, until that GAAP profit is actually printed? That's the whole story right there.
Thank you for tuning in. We hope this deep dive helps you frame your own thinking. We'll talk to you next time.